Unless you have a strict set of rules in place before you place a trade, you are a gambler, not a trader. Guys, I've seen a lot of content online about trading, and I think a lot of it misses the mark because trading is much more than buying and selling. Being a real trader means that you follow a specific set of time-tested rules that you must follow to the letter. My name is Robert Roy, and I am a full-time trader and trading coach, as well as the founder of WealthBuildersHQ.com, where we teach traders technical strategies to build their wealth utilizing the financial markets. Now, I've created and tested hundreds of my own trading strategies over the last 2+ decades, and in this video, I'm going to give you a 30,000-foot view of what it takes to create your own trading strategy. A trading strategy is a specific set of rules that allows for trades that are highly reliable, highly repeatable, and highly predictable. Creating a trading strategy is like following a scientific method. First, you start off with the hypothesis, which in our case is the rules that we believe will generate a net profit in the markets. I've developed what I call the Strategy Creation System, SCS, and I use this system to narrow down the rules for the 4 elements of any trade, which are identify, enter, manage, and exit. All 4 key instruments to that trade setup. With the 4 components, the very first one is identification. What does that mean? How are we going to identify a stock that's going to make it on our list or not? Is this a yes? Does this stock make it on my list for a potential trade setup or not? And there are some rules that you're going to come across for that. Those rules will differ based on the strategy. A covered call will have different rules, possibly than a credit spread. Right? I want to make sure that the rules fit for that stock to say yes to come to my list. So let's use an example. If I want to buy a call, I need 1 million shares of volume on the stock. Not enough volume, I'm not interested in the trade. The stock has to be optionable, or else I'm not interested. The stock has to have options, but there must be at least 100 open interest on that candidate for it to even make it to my list. See where I'm going with this? It's what is the rule that this one can even be added to the list. Now, once I've got the candidates on my list, and let's say I've got my list of 3, 4, 5 candidates for today. Now we need to look at entry. What is the signal that says this is the one? Or maybe even more importantly, this is not the one, right? And that could be something as simple as I want to bounce off of support. That's a signal that says take this trade, right? Now, if the stock was not in a good pattern, and didn't fit, if the stock is dropping like a rock and my system is to buy stock, that's not making it to my list, right? I want a stock that has some upward momentum, some movement to it, to the upside, right? So the stock is on my list. I had identified it. Now I enter the trade on the bounce off of support. Next comes the management of that trade, right? Once you're in the trade, how do you manage that position? How do you set it up that you minimize your risk in that trade, your cost of doing business? Some will call it your losses. How do you minimize the amount of money you have at risk in that trade and manage your way through that position, right? Where are you setting your targets? Do you have more than one target? Where is your stop? Do you have more than one stop? Does the stop going to move? Are you putting a trailing stop in? You see, all of this is management. From there, we get to our 4th component, which is exit, right? And the exit basically says trade's done, right? Is there a reason you might pull the trade off early, right? That would be part of your exit. Maybe bad news comes out about that stock. It's time to get out of that trade. You were bullish. The market's been moving great in your direction. The stock's moving great. Bad news comes out. Earnings, as an example. Time to go. Right? So the exit says, what are you doing to completely get yourself out of that trade? And you're done. Now, once you have these rules in place, you can backtest that trade and or paper trade, non-funded trade, according to the rules set out utilizing the Strategy Creation System. In the scientific method, this is what's called the experimentation phase. A couple of talking points here. When you look at taking these trades and you want to test them, it's called backtesting. Well, how far back should you go? Should you backtest for the last 6 months, the last year? You need to backtest for a reasonable amount of time. I normally do, depending on my trade setup, I'm normally doing about 2 years, maybe 5, but it really depends. If you take a stock that has done a major split and they went from $3,000 down to $100, right? Amazon is an example. If you have a stock like that and you try to go back test it for a very long time, you're not going to have very good results because the stock is so low now. You go back in history where the stock was at times, $12 maybe. So I normally look for the average stock about 2 years to go back to test. Next one is, how long should you paper trade? In other words, how long should you do non-funded trading before you switch over to funded trading? First thing is, you've got to feel comfortable with your system. If you don't, then you're not ready for funded trading. You need to go back and do that paper trading after your back test. You need to do that paper trading. I want you to do at least 50 trades on paper. And you need to be at a point that you are profitable at the end of those 50. If you're not, then continue to trade until you are, and you are comfortable with your results. I'm not talking about you're winning 51% of the time and losing 49% of the time, because I don't really care about that. What I care about is if you win 30% of the time and 70% of the trades go against you and you're profitable, that's all I care about. Are you profitable? But I'm also not talking about, are you profitable by a penny? Do you feel the effort and the time you spent on that number of trades was worth the energy that you put in? And then, and only then, would you consider that it might be time to move on to funded trades. Tracking your trade, or what's also called journaling, is another key element to success. You need to document that trade. When I first started off, there were no computers when I started, guys, at least not like there are today. I had them in business, and an IBM took up a whole flipping room of how huge one box was, okay? What now fits into your cell phone fit into this whole room. Well, for me, everything was paper, right? I wrote down every detail about the trade. The symbol, the time I entered the trade, the emotions that I had in that trade, whatever details, the bid and ask, so I could see how big the spread was, what my stop was, what my target was, all the details of that trade go down on there. Now, you could go and do it a little bit differently today. You can go into a TradeStation or a TOS, into Omega Charts, and you could do non-funded trades there, and you can document right on the charts exactly what you did. Here's my entry. Here's my target. Here's my stop. You could put a note in there of what your emotions are if you want, right? And the emotions were more important for me on the exit than they were on the entry. Usually the emotion was excitement for getting in the trade. But journaling is a key component to your success in the market. The last stage of the scientific method that we'll consider is the conclusion from the paper trades, the non-funded trades that you've taken through your back testing. So you back test first, you go into non-funded trades, and then and only then do you make it into funded trades. A way to determine whether or not that experiment worked is you need to watch things like your win rate, right? How many trades did you win versus what you lost? What was your average win-loss in a trade? What was your max drawdown? In other words, on average, I did 50 trades and I made $200 per trade. Yes, you had ones that went against you, but you made $200 on average of every trade, which means you had trades you made $400, $500, ones you lost $300 or $400 on, but average, right, was $200. Now your max drawdown says how much does your system drop in the value of your account for the trade at a maximum. So you may make $200 a trade on average, but realize that your drawdown for that one trade, and it might have been just one, your max drawdown was $2,000. Well, is that system working for you if you had to give up $2,000 risk potentially to make that $200? And I don't mean on a one-off trade. I'm talking about the worst trade you had dropped $2,000. You have to know these factors when you're looking at building out your system. So what did this trading experiment conclude? Were you profitable? Did you lose money? Were you up and down? Maybe were you broke even? Did you need to tweak any of the rules? So let's recap. Start off with outlining your rules. Remember the strategy creation system. Identify, enter, manage, exit. You're going to backtest, paper trade, and journal. Run all of the numbers. Then and only then you're going to determine if your strategy needs to be tweaked or if it works for you just as it is. And if it needs to be adjusted, the process starts all over again. And there you have it, your own trading strategy. Until next time, make it a profitable day. Stay focused on the quest to becoming a great trader. Keep crushing it, and remember, you're just one trade away. Check out some of our other trainings right here.